Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to advise you to stick to your day job. Now, of course, I don't mean that to be insulting or judgmental or any of those sorts of things. The point is that some people just aren't suited to being investors. Some people aren't suited to running their own business. Some people aren't suited to speculating on speculative stocks, for example. We are all different. We have different interests, different passions, and different skill sets. And that doesn't make us any better or worse than anyone else. It just makes us different. And I think it's a really good thing to ponder, particularly in context of personal investment. You see, there's three ways to generate a passive income. You can start a business, you can invest, or you can speculate. But the key word in that sentence is passive. Passive means that you can generate economic benefits without the need of your own personal exertion. Since it doesn't require personal exertion, it then frees you up to spend time on other activities or spend time with loved ones and so forth. And that's really ultimately the goal for most people, is to build an asset base so that they have a passive level of income and capital growth to free them up to give them choice about what they want to do. Now, arguably, those three options, business, invest and speculate, have merit in certain situations with certain people. But the point is that they don't suit everyone. And if you try and force yourself into a position or a way of doing things that just isn't within your skill set, your natural level of talent, your interest, it could end up costing you a lot of money, stress and time. So before I get into expanding on that and applying it to personal investment, let me first cover a little bit of theory and then share a story about a personal story of my own. So firstly, the theory is based on what Jim Collins, who's a prolific author and researcher, has called the Hedgehog Concept. And the Hedgehog Concept was made famous by an essay that was written many years ago, and it refers to an ancient Greek story. And the quote, or the Greek story, which is really just a quote if you like, is that the fox knows many things, but the hedgehog only knows one big thing. And Jim Collins illustrated this hedgehog concept by drawing three circles that all intersected. And it was that intersection of these three things that is the hedgehog concept, that is the hedgehog that you need to really focus on, whether you're a business, and it also applies to you as a person and where you're spending your time and your energy. And the three circles are, firstly, what are you deeply passionate about? Secondly, what can you be the best in the world at? And thirdly, what drives your economic engine? So what are you passionate about is self-explanatory. What can you be the best in the world at? So it might be one specific thing, but we all have a talent and a natural talent. And what is that thing? And you've got to focus the brutal truth, the brutal reality. I'm never going to be the best in the world at playing piano. There isn't a musical bone in my body, and it's just never going to happen. No matter how passionate I was or how much money I could make from it, I would never be the best in the world at. And the last one is, what is the economic engine? Really goes to, can you get paid for the thing, this thing that you do? And so the thesis that Jim Collins came up with was that one of the things that made companies go from good to great, which is the title of his book, one of his books, Good to Great, is that they focused on the hedgehog concept and they ignored all other opportunities. They didn't get distracted by it. By the way, that Jim Collins book, Good to Great, and his other book, Great by Choice, he's written quite a few books, but they're the two that I think stand out. Good to Great, one of the best business books I have read. So let me share a quick story before I again relate this to, maybe a couple of stories in fact, before I relate this to personal investment. So I have some friends that are very successful property developers, and they make substantial six-figure profits, like substantial profits. And in the past, certainly over the last maybe 10 years, I've considered whether I should get involved in property investment too, particularly given my background in terms of understanding the property market, certainly understanding finance and taxation knowledge and so forth. I would think that I would have at least the knowledge set to attack property investing and probably make a good go of it. However, a few years ago, I decided to focus on the Hedgehog Concept, and property development just isn't for me. Now, the thing I think about is that property developing takes a lot of time. It's not a passive investment, firstly. And so I need to ask myself, where else could I spend my time and what is the payoff as a result of that? Now, of course, I could dedicate 100 hours towards undertaking and completing a property development, and that would generate a once-off profit, hopefully a once-off profit. Okay, so that's option one. Option two is I could dedicate that 100 hours and just think about ideas that are going to help my client, or clients I should say, build wealth. And really, even if I just dedicated 1 or 2 hours to doing something like that, one idea could create a lot of value for my clients and for myself. Obviously, for the clients, it's obvious. If I've got an idea to help them build wealth, there's obviously some value in that. But also it's going to create value for me because, firstly, that client's going to be stickier. They're going to continue to utilize my services and the services of my business for a lot longer. Plus, also, they're going to refer people. So one drives short-term profit, that is property development. The other one, to my mind, drives long-term value. So that's the economic engine part of it. The other two parts is that I'm not passionate about property investing. And maybe I could be the best in the world at it, but I'm not sure I could because I'm not passionate about it. Whereas I'm deeply passionate about delivering the best independent financial advice I can. And I'm good at it. I believe I'm good at it. I hope that doesn't sound egotistical, but I am good at it. I think accumulating a lot of very happy, ongoing clients is going to deliver reasonable economic returns. And that's my hedgehog, and that's what I'm sticking to. So rather than getting distracted, and it's ultimately helped me build my personal wealth by doing that, by having that focus. Look, one of my mentors who has operated a successful business for more than 50 years and has built significant personal wealth has said to me, Stuart, every time I've done something that's outside of my core business, it's cost me in terms of time and money. He's done the property development thing, by the way, in the 80s and 90s and didn't work out for him. He's much better off to spend the time on his hedgehog because that's what's going to deliver the profits and returns. Just as a sidebar, as an adjunct to that story, it's true for medicos as well. So we have a lot of medico clients and the banks love lending to medicos, which is doctors and so forth, anyone in the medical sphere. They love lending to medicos because mortgage default rates, so that's the people that don't make the repayments on time and go into default, it's very, very low, nearly half or less than half of average default rates across, the broader population. So they're very profitable clients because their loans don't go bad. But it's widely known in banking circles that if you lend to a doctor for home and investment purposes, it's perfectly fine. The default rate will be low. But as soon as you lend to a doctor for any other purpose, like property development or buying an unrelated business, default rates are terrible. And there's a deep amount of statistics in this, so it's not anecdotal in terms of evidence. So it sort of reinforces that we all have a hedgehog concept. We all have a hedgehog, and sticking to it is highly profitable. When we start to move outside of that sphere, that's when problems can occur. Let me tell you about my client, Simon. So Simon's been a mortgage broking client. He's for over 10 years, probably longer than that. Of course, it's not his real name. It's a made-up name, but not a made-up person. Over this period, Simon has taken or tried to take many shortcuts to building wealth. So it's included investing in, property types and locations that was popular at the time and sexy, if you like, lacked fundamentals. He's tried to build other income streams outside personal exertion, in small little businesses and so forth. And none of these activities have actually helped him build wealth over the long run, and some of them have been absolute financial disasters. But Simon earns an above-average income, and he doesn't overspend, lives pretty frugally from a living expense perspective. So he's got a good, strong, reliable cash flow, but it's really about trying to cut the corners to try and build wealth over time. It hasn't really worked out for him. And really, Simon would be in a substantially better financial position if he just stuck to evidence-based strategies and, quite frankly, not listen to his own ideas or advice. In fact, if he just listened to common sense, evidence-based, honest, independent financial advice and just blindly followed it and shut out all the noise in his head, he would be in a substantially better financial position today. It's funny though, it's not funny, it's ironic that mistakes compound as well. So quite often, someone will make a financial mistake, they will lose money, and then they will try and brainstorm all the ideas that they could possibly implement to mitigate this one mistake. I lost $100,000. What can I do to gain that $100,000 back? It just promotes a whole bunch of short-term thinking that's not really ever going to build long-term value. And it invites people to make one bad decision after another. You're much better off just in that situation. You go, okay, I made a financial mistake. The best thing I can do is start making good quality financial decisions and resist the temptation to divert, to get distracted by shiny objects and so forth. And that's why this blog is titled Stick to Your Day Job, because what you need to understand is you've got to find your hedgehog concept. And then you're much better off to stick to that and dedicate all your time to that and outsource the rest. And if that includes investing, outsource it. I'm not saying outsource the responsibility. That's your responsibility. It's your money. You can't do that. But in terms of understanding whether you're going to be a great investor, that's what I'm really talking about. There's a proverb that says a little knowledge is dangerous. Well, I think it should be rewritten if it's going to apply to investing. And the proverb should be anything short of complete knowledge is dangerous. Because I've got some clients that are actually quite financially astute. They understand most things, but they're just missing the last 5 or 10% of knowledge and or experience, by the way. Could have all the knowledge in the world, but no experience. I'd argue it's worth a lot less. You need both. But that last 5 to 10% can be critical often. And it's the difference between being completely wrong or being completely right. So the fact is that some people will never be great investors. It just is how it just is. Some people will never be successful entrepreneurs. That's okay too. It doesn't make them bad people or lesser people. It just makes us all different. So you must find what you're good at and then, as I said, delegate all the other things. The hedgehog concept applies perfectly well to personal investment. And really it goes to or invites you to ask 2 questions. The first one is, can you be the best of the world in the world at formulating and implementing Australian-based investments? The second question is, are you deeply passionate about investing? And don't forget, passion is more than just an interest or a hobby. Passion is passion. Now, if you can honestly answer yes to both those questions, and I'll repeat them again. Can you be the best in the world at formulating and implementing Australian-based investments? And secondly, are you deeply passionate about investing? If you can answer yes to both those questions, then I'm tipping that you should look after your investments, and you'll probably do incredibly well. In fact, you will. You'll do incredibly well. But if you can't answer yes to both those questions, then it's very likely you're better off sticking to your day job and then paying for and following, most importantly, high-quality financial advice. And when it comes to building wealth, quite often the slow, boring path is typically the most successful to build long-term wealth. Now, of course, I've got a vested interest in saying if it's not your core competency, outsource it and pay a financial advisor, because I am one. So I acknowledge that is a conflict of interest for me giving that advice. But I don't care if you come to me or someone else. Just make sure they know what they're doing, they use evidence-based strategies, that they're completely independent, that they've been doing it for a long time and they've got runs on the board. So whoever it is, that's fine. But the point is that if that's not your hedgehog concept, if you're never going to be the best in the world at advising and implementing in relation to Australian-based investments, why take the risk with your money? You are much, much, much better off dedicating all your time to your hedgehog concept and being the best of the world at that, and then having some smart people look after your money than trying to do it all yourself. Anyway, I wanted to share that story because mostly it's something that I see relatively regularly, where people that are never going to be good investors either fool themselves that they are and try and get involved and make decisions and take, a really good strategy and add their pinch of 5%, which ultimately ruins the strategy anyway, or muddle through it. And there's just no need to do it, and the cost associated with doing that can be significant. Okay, that's it for me this week. Until next week, bye for now.